Namaste everyone, welcome to our YouTube channel, The Money Master. I am Pooja Sharma. In the last video, we got to know how to calculate the ROE of a company and a few of the major flaws in considering it independently while analyzing the company's financials. In today's video, we are going to delve deeper. We are going to compare ROE and ROCE, that is return on capital employed, and by the end of this video, you will know why ROCE is Warren Buffett's favorite financial ratio. So let's get started. First things first, what is ROCE? Return on capital employed is a profitability ratio that helps in understanding how much profit is generated from each rupee of the total capital employed by the company. It thus shows how efficiently a company is able to generate profits from the capital it is employed in the business operations. Now, what does overall capital include? It includes both the shareholders' equity as well as the debt taken by the company. And this is the major difference between ROE and ROCE. While in ROE, we divide the net income by the shareholders' equity alone. In the case of ROCE, we divide the net operating income, that is EBIT, by the total capital employed, which is the sum of shareholders' equity as well as the debt taken by the company. This capital employed is the money the business utilizes to run its day-to-day operations or to grow and expand the business, while EBIT, as the name suggests, earning before interest and taxes, is an indicator of how much the company has earned from its business operations before deducting costs such as interest and taxes. To understand the calculation of ROCE ratio, let us take a look at the performance in figures of a company, say ABC Limited. Now, ABC Limited has an equity capital of rupees 300 crores and a debt of rupees 200 crores. And during the year, the earning before interest and taxes, that is the EBIT, was rupees 86 crores for ABC Limited. Now, if we have to calculate the ROCE of the ABC Limited, we'll use the formula EBIT divided by total capital employed. In this case, EBIT is 86 crores. So we'll put the 86 in the numerator and we'll divide it by 300, that is the equity capital, and plus 200, that is debt. So 300 plus 200, 500. And the resulting answer will be 0.17 or 17%. So this is the ROCE of the company. Now, there is a second not so used formula to calculate the ROCE of a company, that is using the total assets and current liabilities of the company. How? We'll see in the next slide. So in this formula, we have EBIT in the numerator, but there is a slight difference. The EBIT is divided by the difference between total assets and the current liabilities of the company. You can find all these values recorded in the company's profit and loss statements. Now that we know how to calculate ROCE, let us find out its application and know why it is such an important financial metric to analyze companies. So, summing up our learning still here, we realize that ROCE of a company is a primary measure to assess the return on company's assets as well as to know how effective the company's management is at capital deployment. ROCE is more so necessary for comparing the performance of companies in the capital-intensive sectors such as Tata Power or NTPC Limited in the utility space or Airtel and Jio in the telecom space. Because, as we saw earlier, unlike other fundamental ratios, ROCE does consider the debt of a company, thereby providing a better indication of the financial performance of a company with high debt. But, there is one drawback to ROCE. It is not an appropriate metric to analyze the businesses with significant amount of untapped cash reserves. In such cases, to get a more accurate depiction of ROCE, one adjustment is needed. For example, occasionally a company may like to hold cash for near future business expenses. In such cases, this cash on hand needs to be reduced from the total capital employed in order to get a more accurate measure of ROCE. Otherwise, companies with underutilized cash reserves may have a reduced ROCE and your analysis of such companies will be inaccurate. Okay, so now that we know how to calculate both ROE and ROCE, you must know that the best way to evaluate a company is to look at ROE and ROCE combined. When the ROCE is greater than the ROE, then it means that the company has made intelligent use of the debt to reduce its overall cost of capital. This has a counter view to this, and the counter view is that when the ROCE is greater than the ROE, then it also means that the debt holders are rewarded better than the equity shareholders. And this is not a good news for the equity shareholders, right? Warren Buffett has given a solution to this problem. He suggests that both ROE and ROCE should be above 20%. The closer to each other they are, the better it is, and if there is a huge difference between the ROE and ROCE, then there is surely some food for thought for an active investor. So, in the end, is there an ideal ROCE value? Well, there is no fixed benchmark, and the ideal ROCE for every business will vary depending upon the sector they are in. For example, you cannot compare the ROCE of HUL with that of Tata Steel, because HUL is in the FMCG space and Tata Steel belongs to the steel industry, right? But you can compare the ROCE of HUL with other companies in the same sector like Britannia or Dabur. Now, as a very general rule of thumb, the ROCE should at least be double the interest rates, because even after cutting all the expenses, if you're not left with at least 3 to 4%, then the investor would be better off investing that amount in the bank FD, right? That's all about ROE and ROCE. Do let us know in the comments section which financial ratio would you like us to cover next, and if you're liking the work we're doing on our channel, then do hit the subscribe button. If you like this video, hit the like button and share it with your friends. Until next time, namaste, bye bye, and take care.